You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. Here we go. Episode 2 of our bi-weekly options extravaganza, known here. I should say, really, our bi-episode. Welcome to the second part of our doubleheader of Options Bootcamp. For all of you listening on demand, you won't notice anything. It's just like another episode hits your feed. But for all you live folks, of course, getting a second episode in your ear holes immediately after the other one. Because we know after one episode of Bootcamp, you're not sated. It's like Netflix. You want to binge a little bit. So luckily, we're here for you to satiate all of your options question asking desires. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever scintillating network upon which so many of you are binging these days. If you do like what you hear, do throw some stars our way, just like Shatter did this week. Shatter with a 3 for the E because he's cool, or perhaps she. I know he says guy, so that's he. He says, 5 stars. I'm that guy that went back and listened from episode 1. Oh, cool. Finally caught up 3 months later, and it was definitely, in all caps, definitely worth the trip. Good content for options traders. Well, thank you there, Shatter with a 3. We appreciate you taking the time to go back and listen to all of our episodes. That's quite the commitment. We tip our caps to you. Looking at the numbers, you are clearly not alone. A lot of people are going back and doing that ride, taking that ride with you all the way back from episode 1. That's why we remastered episode 1 not too long ago. We probably have to go back and remaster a few more along the way. Some of those have been back there for a while, but intriguing stuff. You get a little bit of a history lesson in some of those early episodes because some of those firms that joined us on those episodes no longer exist in the world of options. So that makes it intriguing in and of itself. But thank you to Shatter for taking the time to listen to all of our shows. And of course, going back to rate and review. And of course, if you folks want to get even more content in your lives, and who can blame you, theoptionsinsider.com/pro. That lets you join us live for great, fun, spontaneous doubleheader options bootcamp episodes like we're doing here today. Get all your questions answered. We have another Pro Q&A coming up tomorrow. We just did Pro Q&A 100 last week with Mr. Matt Amberson. Options oddities every week. The Rock Lobster's already sending me stuff as we're talking here for the show on Friday. So a lot of fun stuff. You will find some things to trade, I guarantee you, just by listening to Options Oddities alone. Coming up on the 1st of the month, that means it's almost giveaway time again. You folks going to bankrupt me sending all this stuff to you in the pro trading crates. Where do you go if you want to bankrupt me? theoptionsinsider.com/pro. Once you sign up there, you get your name entered in the hat for the giveaways, all the other fun stuff that we do there. theoptionsinsider.com/pro. Mr. P, sir, what do you have to say for our buddy here, Shatter, going back, listening to a full decade's worth of OBC, sir? Good stuff.
Dude, that is awesome. And, I speaking for myself here, I think Mark shared how he feels about it. I think that's really great and humbling, and I'm honored. I know that I do that too. When I drill down on a particular topic and find a podcast, I go to iTunes podcast or Spotify or whatever, and I just start at the beginning and crank my way through it. And it's kind of a fun way to do it.
That it is. You know what else is a fun thing to do, listeners? It's the mail call. So let's get to it.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the Mail Call, the portion of the show where you folks take the reins, your questions, your comments, your insights. We also, at the start of the segment, like to turn the spotlight back on you. We got a obviously very contentious question of the week out there this week for you folks. If you're listening live, you can still vote. If you're listening on the podcast, it will probably be too late. This will be out next week, so it will definitely be too late. You will have missed this one, which is why you need to follow us at Options on Twitter, listeners. There's always a question of the week, hence the name up there for you to participate in every week. No matter when you're listening, many years down the road, there will be a question of the week there waiting for you at Options on Twitter, listeners. This week, it was about a year ago, Dan. I'm not sure if you realize this. It was a year ago. May 16th of last year was the first week to list the new, effectively, weeklies in SPX. So the zero-day phenomenon, such as you can call it, really began about a year ago. So first off, happy anniversary to all of you zero-day fans. And then B, it was a perfect opportunity for us to ask you now, a year later, has the launch of these products changed the way you trade options? Either yes, I'm a short-term trader now, or no, I don't trade them. Dan, first off, happy anniversary to you. Do you have your party hat that we sent you? And then B, what is your take? Has this changed the way you trade? And then C, what do you think our audience is voting for, sir? A three-parter.
Yeah, well, I haven't gotten the hat yet. I know you like to save money on that shipping, so it's on the.
Well, we shipped it to Frankfurt, but you're in the woods. We didn't know we were going to be in the woods. We got to ship another one to the woods now.
Oh yeah, that's right. Okay. So yeah, and I do trade zero-day stuff, and wait, there were three questions. I forgot one of them.
What do you think our audience is? Are they yes, they've changed the way they trade? They're short-term traders now, or no, they don't trade zero-day?
I am not looking at it. I don't know if it's in the show notes, but I'm going to say that's probably split about 50-50 is my guess. That's my guess.
It's almost like you cheated, sir, because it was until a few minutes ago exactly 50-50. It just ticked. It just ticked as we were talking. It is now 51.7% for no and 48.3% for yes. So this one has been contentious from the get-go. It's been kind of interesting. A lot of people chiming in. A lot of our pro members chiming in. We have Pariah Pants saying, I rarely trade zero DTE, but I love daily expirations. So, okay. I mean, it's cool to see them. Maybe you use them for analysis. Maybe you just like seeing the flow out there, but you don't trade it. I get it. They are intriguing, just from a purely theoretical perspective out there. They give rise to other things like one-day VIX, whether you like it or not. So there is an interesting little ecosystem that's sprung up around them. We got this guy, Mountain Goat Capital. He says, he's pretty surprised by this poll. I've seen others like it. I myself and many I know have been killing it for a long time with zero DTE. So he's pretty much a big fan of it. And then we got Age here, one of our pro members, Age of Del Aquarius, saying, my opinion on zero-day options would get me banned from Twitter. I like that. Yes. Watch out for the ban hammer out there on Twitter land. So, yes, it's a contentious issue. Some people love them. Some people clearly no bueno out there. So, yeah, interesting. I knew it would be close, but I didn't think it would be pretty much 50-50 locked all week. That's kind of intriguing. All right, Dan, before I get out to the rest of the people who are champing at the bit, they are also champing at the bit for a little bit of the old market taker question of the week. What you got for me?
Yeah, so this is, and I'm kind of doing a little bit of a composite character of a question here. This is kind of what I see as a common misuse of certain options here. And so the question that I'm going to sort of make up a little bit here basically is, should I be trading SPY or SPX? Now, this is an age-old one. The guy who went back and listened to all of our all of our shows since the beginning, I might have addressed this one, a few years ago or something.
You're going to tell him you should trade the OEX again, aren't you? You're that guy.
Yeah, exactly. So, there's a couple of differences. There's potential tax differences. I always have to clarify that one because I am not a tax professional. I don't pretend to be one. I hire somebody to do my taxes because it seems like a really boring job. And but yeah, talk to your accountant about the potential tax benefits of SPX over SPY. There's also settlement differences. There's some nuances, but the biggest difference to me is the contract sizing. And there are basically 10 SPY calls for every one SPX call. SPX is a very, very big institutional sized contract. And like one of the big mistakes that I see a lot of people making is they're like, oh yeah, I'm a 5-lot trader. I'll trade 5 contracts of Ford. I'll trade 5 contracts of SPX. It's like, no, that is not congruent right there. A 5-lot in SPX is like $1.6 million that you're controlling. Like it's a humongous trade. And for some people who have really big accounts, that that might be what they should be doing. But for a lot of people, they just think of it, one contract. Yeah, okay, it's 1 lot. And the 1 lot's $400,000 you're controlling. Lots and lots of risk. So if you're, I look at account size sort of as an upside down period, right? Like a pyramid. There's lots of small accounts, fewer medium-sized accounts, and fewer very big accounts. So most people, given that logic, should be trading SPY, which is just a normal sized trade, I would say. So hopefully that helps.
It always helps. It's our listeners. They have all sorts of fun feedback. Let's see what they got here. Let's go out to the live chat list. Remember, if you're on the pro side, you get to listen live. Also, all your questions always and comments. We love them all. Get bumped to the top of the list. Looks like we prompted some chat on our last episode, Dan, talking about trading floors. We have a bunch of listeners like Options Queen saying Frank 1209 saying he can't imagine trading on the floor. And then Options Queen agreed. She said I enjoy trading from my home and not being surrounded by others. Although the floors now seem a lot better than the ones from years ago. Yeah, that's what we were talking about. They are much more pleasant. I don't think that's done by accident, Options Queen. I think it's fair to say that, the prior trading environments were not exactly welcoming, and certainly not to everyone. I mean, Dan and I probably count on one hand the number of female traders we saw down there on the floor. So it wasn't exactly a welcoming environment for everyone. I think they're trying to rectify that now, making it a little bit more pleasant so more people can participate in this. So who knows? Maybe Options Queen, maybe you'll see a glimpse of the new SIBO trading floor and you'll decide you want to go down there. After all, you have been eerily precise on a lot of your vol prognostications on our volatility views program. So if you're not managing a vol book, you should be already over there in VIX land. Option God, I'm interested in trading on the floor. I think that the social aspect would be nice in addition to just being around the trading environment instead of at home. But yeah, there was some of that. I mean, remember, you weren't surrounded by friends usually. You were surrounded not even by coworkers. You were surrounded by antagonists. There were people out there who were competing for the same dollar as you were. So it wasn't always the most welcoming of environments. But I think from a social aspect, if you mean getting a sense of what's going on in the market, and yeah, that was it kind of way before there was a Twitter, before there was a social media. You saw the rumble, then the news develop across the trading floor in ripples, and you knew something was happening. Usually it would start out in the SPX or even in the early days out in the OEX, which I was joking for some of our newer listeners, the OEX listeners, is the S&P 100. It was the big pit on the SIBO way back in the early days. Not really a thing so much anymore. Not a lot of people trading the OEX. It also was the index that the original VIX was calculated off of, if you want to go back to the dark primordial ooze days there. So imagine that, the VIX of the S&P 100. Who cares? The answer was nobody. That's why they changed it. But yes, there was that aspect to seeing what was going on out in the market, which was nice. People like the Starbucks. Dan, the Starbucks really, the MyX folks, I think they got a home run with their Starbucks on the floor. They also said, I can understand that, especially if I can bring my Starbucks on the floor with me. Yeah, Dan, how about that? Can you imagine having a barista on the trading floor alongside you, sir? That would just be strange. I remember the days in the SIBO, we used to joke, you have an easier time bringing a gun on the floor than a bottle of water. They were so obsessed with liquids and food. They would send you to the hole forever if you brought a bottle of water on the floor. Now a Starbucks on the trading floor. Can you imagine such heresy, sir?
Yeah, I know, man. That sounds crazy. And you're probably right about easier to bring a gun on the fly. I heard stories about it that there was this guy who always was packing, uh, which sounds really
I'm
pretty.
sure they were packing. There was no metal detectors. Nobody cared.
I
You
know.
could bring
I
any
know.
of that crap you wanted. As long as you didn't bring water, they didn't care what you brought.
I know.
It was ridiculous. It wasn't until 9/11 happened and people realized, hey, maybe we should have some actual security here. Then all of a sudden they started locking everything down. But yeah, we used to joke, anyone could bring a gun down there and just take out half the floor and it would be easy. So yeah, those were the good old times, aka the dark times. Going back to our live chat, Age is also listening live. He's our Twitter friend as well. Age says, how about another? Oh, I love this. How people can go back to the early days of the network. Age wants, how about another option block live at the Elephant and Castle? I didn't live in Chicago for the one in 2011. Yeah, that was awesome. Thank you for bringing that up. That was a fun memory. That was really, I have to think, that was probably our first big live event that we did on the network. It was myself. It was Mr. Meatball. It was a bunch of the guys from OX at the time, like half of the OX crew. It was an awesome. Tusa obviously was there. I think Auntie Mike at the time. Kavanaugh was with us as well. So yeah, it was a great. We rented out Elephant and Castle, a bar down here in Chicago, listeners. We had a whole bunch of people in there listening and drinking on our dime. It was fun. And that's one of the few times, Age, I've ever seen the Meatball speechless, because as we were doing that episode, Sheldon Natenberg walked in, aka the author of Options, Volatility, and Pricing. And for many of us who started in the early days on the SIBO, that was the Bible we were handed walking on the floor. That was a big deal. So when he walked in, Meatball saw him and he leaned over to me and his eyes were just wide. And he said, I think that's Sheldon Natenberg. And he just kind of froze. So it was fantastic. I still tease him about this to this day. He's a groupie for Shelly Natenberg out there. So yes, we would love to do that. We have done a bunch of option blocks live since then. Just obviously they've all been around, like that summit we did with those guys at the SIBO a couple of weeks ago. So we have done live ones. We have a video of it right now, the one we just did a couple of weeks ago at the SIBO. But you're right, that's all been for their membership, so it hasn't been for you guys. So maybe we'll revisit that now that we got hopefully some pandemic era restrictions behind us. We can all gather together again. Maybe that would be fun. And you know what, Dan? We've never done, I mean, you and I have done some for your mentees live shows. We've never done just a full and open OBC episode for the crowd. Maybe take over a bar somewhere like Elephant and Castle and do that. Would you be down for that, sir?
Oh, man, that would be super fun. Yeah, that would be great.
All right. Dan's in. It looks like Frank says he'd be down for a live show, either option block or boot camp. Yeah, you take them both. So a lot of people are in. They're all in. Our chat's in. They want live shows, Dan, not just live here, but live in person. They want to press the flesh, Dan. So maybe we'll see if we can make that happen out there. What's that? You all want to buy us drinks and steaks at Gibson's? How nice of you. So they want to put it on their tab, Dan. Age also mentioning he wishes Options Express still existed. Yeah, those were good days doing that show with those guys. It was nice to have a very options-focused broker. Obviously, they're now part of the Schwab Leviathan now. Not quite as option-centric, so it has lost some of those bells and whistles. I think they've mostly focused on the toss side over there. So yeah, OX kind of is still around, but not quite what it was, obviously. So yeah, I do miss those guys as well. Another guy chiming in, Option God. Sounds like the early trading floor experience was unbelievable. I can't imagine that working in this environment at all. Yeah, no, it wasn't, shall we say, the most politically correct of environments. I'm not sure if it would fly in the modern parlance out there. Let's keep on rolling some of the questions you folks have sent in on the on-demand side. Not just all live folks, even though we love all of you folks out there. I like this handle, The Big Beast. The Big Beast. I like that. The Big Beast wants to know, just a follow-up on last week's OBC. I'm a little confused on the whole crossing thing. A broker is allowed to just put up prints inside the NBBO without ever having to expose it to market makers and traders? How is that legal? Mr. Dan, sir, regale our friend who's got a great handle, The Big Beast. I might have to start using that myself. The Big Beast wants to know, what is crossing? How is it legal, sir?
Yeah, that's a great question. You should pose that question to the folks at the SEC who allow it to be legal. The same folks who talk with their friends at Goldman Sachs and leave the SEC after working there for 2 years and take a job making 10 times the amount of money? Those are the people you should pose that question to. It's pretty crazy. It's not good for liquidity. It's not good for public information. It's murky at best. You find out about the trade later after it happened. It's not good for competition. It's pretty weird, man. It's pretty darn weird.
Yeah, the whole process of crossing, I mentioned before, that was kind of the straw that broke the camel's back for me on leaving the liquidity providing side. So I don't think it's a big stretch to say Dan and I are not huge fans here. Anything that's not really exposing orders to the market, not a good thing. And there are other issues as well, which are brought up by our next questioner / commenter here. This is Aiden. He says, so it makes sense that a brokerage firm would want to line up customers for both sides of their trades. They get paid twice. Yeah, exactly. So if you have a customer coming in looking to buy calls, if you can find another customer looking to sell those exact same calls, guess what? As a broker, you're getting paid on both sides. It's a win-win for you. But as Aiden goes on, he says, but I'd imagine that the original customer isn't really a fan because their order is delayed while trying to find interested counterparties. Plus, doesn't that let the whole world know what they're up to? Yes and yes here, Aiden. You're a very savvy fellow. You figured that out pretty quickly there. Yeah, that's the dark side of crossing, in addition to what Dan and I just laid down, which is, of course, it's disguised as liquidity. It really kind of eliminates the incentive for market makers. That said, if there's a really big print, someone like a Citadel is going to step in and say, okay, we want a piece of that. And they have enough muscle to get away with it. So if it's really juicy, they're going to give you some of it. That was the other problem with this kind of stuff, is that you started seeing the really good trades, the ones that you actually had quote unquote edge, the ones that you were paying to be down there for. Those were all getting crossed ahead of time and then coming up to the floor and just being stamped, being printed right in front of you. And you got none of it. Meanwhile, the garbage that was pretty much, buying on your offer and selling on your bid, that kind of garbage, that was all available for you to trade all day. So they were cherry picking the order flow on top of it, which is another disincentive for market makers to be out there. But yes, if you're a big customer now, you have what's called information leakage, because your broker is effectively shopping your order to other people saying, hey, this guy wants to do this. Do you want to take the other side? And even if you don't want to take the other side, you just heard about that. You're like, oh, maybe I want to front run this guy. I want to do that. So that's a big problem. And that good brokers will be diligent on who they show it to and how much information they let get out, exactly so that doesn't happen. They don't want the market to move away from their customer. So their customer, they get front run and then they lose that customer. It's kind of a delicate dance because the customer also wants to get filled at the end of the day. And if that requires someone shopping the order around a little bit to get a fill, then maybe they're okay with it. But on the flip side, if it takes a long time to fill it and their order is just shopped to high heaven and everyone knows it's coming, then yes, they will be disadvantaged by that process. So that's a good point, Aiden. And again, crossing, a very contentious issue. If you put it up to brokers, they'll say it's the best thing since sliced bread. Put up to a lot of other participants in the market. Exchanges like it too. They get volume. They get paid. They don't care. The exchanges are kind of looking the other way, allowing all this volume to go up. It's obviously the liquidity providers who paid the brunt of this, which it's already happened. Most of the liquidity providers are now gone. You're left with your handful who are kind of running the whole business, which is kind of the way a lot of people thought it was going to go way back in the early 2000s. Let's go to this one, Dan. Let's go here. We're coming up again, so we got time for. We could do at least one more. Let's go to JC. Well, first off, any other things you want to add on crossing real quick, Dan? Are you good?
Yeah, no, it's good. Yeah, let's see what JCVD has to say.
He's got a good one. Let's go to JCVD. It says, can you walk through an example of an upside call backspread? Heard about it on a video and wasn't really sure about the mechanics or why I would do it. Yeah, we tend to call them, ratio spreads here, but, backspread, that works too. We try to avoid that kind of terminology because it gets a little confusing. Ratios, a little bit more straightforward. I think they can understand that. You're doing one, you're doing several more of another leg. They can wrap their heads around that. You start saying front spread and back spread, people are like, what the F are we talking about? You actually have good timing because we were just talking about this on our Volatility Views show, a very recent sizable example. VIX is a primary example of this. What are we talking about, listeners? We're talking about usually a spread where you're going to sell one and buy more than one, usually two, sometimes three or four or more, farther out of the money calls against it. Now, if you can just sit in your head and think about that intuitively, why would you do that? Why wouldn't you just buy the one call you want and just call it a day? Well, first off, that one call you're selling is probably pretty expensive. And B, if you get an explosive move to the upside, then having more of the calls farther out of the money is actually going to make more money if you get a really dramatic, aggressive move versus having the one closer to the at the money. So it's taking advantage of leverage, keeping things a little bit more cost effective as well. And where we used to see a lot of these selling one, buying two, selling one, buying three is in VIX. VIX is the quintessential product for a trade like this. We haven't seen a lot of them over the last year or two until this past couple of months. All of a sudden, with VIX dropping back down into the teens and with the curvature out there the way it is right now, all of a sudden these ratio spreads are becoming more popular again. And so we did just see, just a couple of weeks ago, it was May 4th, someone coming in, what I kind of dubbed at the time, I think the return of the ratio spread out there in VIX land. Someone selling 100,000 of these September 40 calls. They sold those for $1.59. And then they bought 300,000, so 1 by 3 listeners, of the September 60 strike, I should say, calls for 69 cents. So again, selling 100,000 of these September 40 calls and buying 300,000, so 3x of these 60 calls, selling the 40s for $1.59, buying 3 of the 60s for 69 cents. So obviously, if you want to work out how much they did this trade for, listeners, you have to multiply that 69 cents by 3. So they collected $1.59 to sell that 40 call. They paid $2.07 for 3 of the 60 calls. So it net worked out. They still paid for this, but they paid 48 cents versus straight up paying $1.59 for 100,000 of the 40 calls. Again, why would you do this? And you can maybe argue and quibble about the strikes. I mean, 40 strike is pretty far up there for VIX. We haven't kissed that or even really sniffed that in quite a long time. But that said, this is obviously a type of trade looking for, or probably more apt in this scenario, hedging against a massive explosion in VIX. This is probably someone with a credit portfolio or something else where they have massive exposure to short VIX and they don't want to be run over if it explodes against them. This is their way to hedge it. And you could just see straight up, they saved themselves over $1 by doing this. They saved themselves $1.11. And they have a position that if it goes up to, 41, 42 and expires there, it's not going to be that great. But if it explodes through the upside, that's kind of what this is really hedging. Then you're doing all right. And also, it's a bit of a misnomer that it has to really aggressively explode. Obviously, that would work well for this trade. But if you start seeing a nice aggressive move up into the mid 30s in the next month or so, like just explosive upside move in VIX again, you would see this trade actually start to do well. Obviously, you're short the 40s, but you're long 3 of the 60s. And as we've talked about with Matt and others, once you start getting into that garbage call realm, the far upside of the skew in VIX, they have this skew component, this volatility component that will kick in pretty aggressively. And you don't need to get all the way to 60. You even have to get that close to see that leg of the spread start to tick up. So this spread can make money in more environments than just the explosive move to 80, even though that would obviously be awesome for this trade as well. So Dan, there's a real world example of someone doing these types of upside call ratio spreads. What are your thoughts on these types of trades in general? Why do you like to do them if you do? And then what are your thoughts on this one in particular?
Well, I mean, in general, I'm not a fan of them. But everything sort of has its little niche in the ecosystem that is options. And, usually when you see a trade that's 100,000 by 300,000, there's a reasonably, so, I look at this trade and I see that, somebody's looking for a pretty good upside move. And like you pointed out, it doesn't necessarily have to get up through the break even or anything, but, the at expiration break even. But that is a pretty good upside move, but it's a cheap bet. What I typically don't like about these, and, somebody who's trading this big, I'm not going to be a hater. I'm not going to say I don't like this trade. Like, it's got my attention. But generally speaking, what I don't like about these sorts of trades is, you're bullish, but if the underlying goes up some, you end up losing. Like here in this example, if close to September expiration, if this person even plans on holding until close to September expiration. But, as we approach September expiration, if the VIX is trading around 40, this person's going to lose a lot of money. And, with something like a vertical spread, credit or debit spread, like it's really easy to say, okay, they lose this much here. Just looking at these numbers, it's a little bit trickier. You have to either draw this out or model it out on your platform. But having not modeled this out yet, I don't know what the exact value is, but this person can lose a lot if the VIX is around 40. It really has to bust through that barrier. And that's the challenge with these types of trades.
You got time for one more, an Apple collar, sir?
Yeah, let's do it.
All right, let's do one. We were just talking about collars on the last show, so I can't leave this person empty-handed as well. We'll get out of here on this one from Matt Stone. Matt Stone wants to know, are you guys fans of collars? Well, spoiler alert, yes. They're fun. We like them. I talked about them specifically on our Advisors Options show. For that audience in particular, the financial advisor, asset manager, you're managing a long-only equity portfolio. It kind of combines the two favorite positions you have, the long put and, of course, the covered call. So for that audience in particular, big fans. For some of the retail, maybe a little bit less so. We'll get to the question here in a second here. Matt Stone goes on to say, what is the best way to trade them? I'm specifically looking at zero-cost collars on Apple in the first 2 months. Thanks. Well, since you sent this in, I did pull up Apple while we were talking here, Matt. And Apple, when we pulled it up, was right around 172.25, listener. So Apple selling off almost $2 today. So they're not liking themselves some Apple. Days that Apple is red, I always joke the market is angry when Apple is red. We looked at a straight, you said the first 2 months. And so we looked at a straight front month at the money put, right around that 172.5 strike. It's going to cost you $3.50. That's a lot for a straight at the money put. You probably don't want to pay that. So we thought, let's start looking at some collars. And if you go $10 out of the money, so the 162.5 strike, that put cost you $1 1 month out, which actually isn't terrible for Apple, but it's still a lot. If you turn around against it, obviously you're going to see skew in these names. Interesting thing about this, the Apple call skew seems decent. It's not as bad as you usually see. You only have to go $8 out of the money to write a call against it. Usually you have to go closer to the at the money, maybe like $3 out to make the call that's usually going to be worth less than the put, make that equivalent. So in this case, you could do a zero cost collar 1 month out. You could do the 162.5, 180 collar and get that on for no money. And that's not as bad as we usually see. I think partly because there is more upside call interest in Apple than in your standard name. So that gives you a lot more reward for the collar. So in this particular, the covered call angle, obviously. So in this particular scenario, I don't hate it as much. Obviously, if you went and bought Apple right now, you still wouldn't want to lose $10, which you could on this collar. But maybe if you're long it from 140 and you don't mind stopping yourself out around 162.5, then this wouldn't be the worst trade on the planet. But typically, I don't love the zero cost collar because they don't always line up this nicely. Usually they line up and you have a put. You maybe still have to put it much farther out of the money than you normally would want to in order to be able to afford it. You want to maybe tight add the money put. Instead, you have to go a couple of standard deviations out of the money. And then you have to sell a call that's just a couple of ticks above the add the money to pay for it because the skew is all out of whack. And it ends up just being a disaster. So normally I'm not a huge fan. Normally I'm a fan more of pushing that put out a bit and then selling consecutive, say near expiration, covered calls against that. And over time, that should be able to compensate you for most, if not all, of the cost of that put if you do it correctly. But straight zero cost, usually not a fan. In this case, Dan, because everybody and their mother loves Apple, it doesn't seem like it's the worst trade. So what are your thoughts here on zero cost collars in Apple? And you kind of mentioned on the last show, you're more of your split time approach. Is that your preferred way to do a collar, sir?
Yeah, I mean, that is generally speaking my preferred way to do it. I mean, it's very situational, for what is called for. Actual zero cost collars, for most stocks, you end up having to sell a call much closer to the strike than the put is. And so you still have this sort of unbalanced risk. So to me, it's a balance. Like if you're doing just a straight collar, it's always a balance between is it more important to me to have zero cost and have like the stock can only go up so much, but it has to go down more? Or do you want the other side of that where I'd rather buy a more balanced call to put moneyness ratio, but then pay a little bit for that. So it's typically a balance, except of course for the stocks that have, like a full volatility smile or even a volatility skew to the upside, meaning the implied volatility is higher on the call side. Then you can structure some really nice collars. But typically when stocks have that volatility skew to the upside, it's because they have a history or there's a lot of suspicion that they can explode to the upside, like a short squeeze candidate or something.
Yeah, whenever you're doing things and premium is your first and guiding goal, then it's never going to be optimal. At the end of the day, you should really put on ones for the positions that you want, the strikes that you want, and then let the premium chips kind of fall where they may. And if you want to adjust a little bit around those levels to make things line up a little bit better, that's fine. But if you go out there with this intention, it has to be zero cost, you're usually going to wind up with suboptimal strikes. In this case, you don't often see them be close to this symmetrical in the equities. Like I said, effectively, you can buy a $10 out of the money put and sell an almost $10 out of the money call, an $8 out of the money call against it. And again, that's thanks to the Apple love people have with the calls. You're not usually going to get that. Usually going to buy a $10 out of the money put and have to sell maybe like a $1 out of the money call against it. So as Dan mentioned, it's very asymmetrical. This is almost symmetrical. This is almost a smile. So that's nice. Maybe if you want to take advantage of that in Apple, that's a way you could go. But in general, zero cost collars, Matt, anything that's driven first by making the premium line up a certain way, not my ideal way to do it, but I do like collars. Collars are a good position provided you understand all the moving parts and all the drawbacks that are buried within. All right, Dan, that music means we've come to the end. Man, another epic show. You and I are doing a lot of talking today. I guess that means we must love the people, Dan.
You know what? We do love the people, and we appreciate the people too, because otherwise we'd be, we're going to be hoarse at the end of the evening either way. We might as well at least help some people along the way, right?
Exactly. Thanks to all of you who joined us live. If you want to join us in the pro for future episodes, heckle Dan over here, all the rest of our shows we do. Get your name in the hat, of course, for giveaways, and of course, get your pro Q&A sessions and your options oddities as well. TheOptionsInsider.com/pro is the place to go to learn more. And Mr. Dan, if folks want to learn about everything cooking in the land of MTM, where should they go? What should they do?
We welcome you with open arms at markettaker.com. Market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, and markettaker.com. And you can join free and participate in our right now complimentary chat room and a lot of our other offerings. We've got a lot of free classes there. It's great if you're a beginner, and it's even better if you're already experienced and want to get even better.
Yes, there you go. My producers reminded me we will be joined by the last emperor himself, Mr. Constantine from Fidelity, tomorrow in the pro Q&A session. So you folks remember him from the option block. Get your questions in now on the pro side. We'll be answering those on our usual time slot for Options Bootcamp. Education Wednesday, we'll be doing our pro Q&A then. So get those questions in now via your members hotline. That'll do it for us on OBC this week. Stay tuned for all the rest of our usual programming, including our pro Q&A tomorrow. TWIFO and episode 2 of the Option Block on Thursday, Friday volatility views and options oddities for you pro folks. Then back again next week with another great Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.